Hello, Marc from ADM Investor Services International with some thoughts on this week's US inflation data, how it's played out in markets and what the sort of prospects are. So what I'll start off with is a chart of a US headline and core CPI way back since 1990, just to put it in perspective, just what sort of a spike we're seeing here with headline inflation at 5.4%, and core inflation at 4.5%. We've not seen these sort of levels since the early 90s after the late 80s spike. So that offers some historical perspective. It's interesting, I think, above all, given a lot of what's driving this, as we will see on my next table, which is the breakdown of US CPI, is a lot of this is clearly due to energy prices. Energy prices in the sort of 40% area in terms of year-on-year increases. I think the right-hand column is interesting, though, because really what it tells me is pretty much everything is above the Fed's 2% target. It's got plenty of room. Perhaps most notably, the ex-food, energy and shelter component at 5.9% does really actually tell us just how much of reopening is contributing to this. The parts which people will take certain comfort from is that services prices at 3.2% are still relatively benign. And the fact of the matter is that food prices are actually acting as effectively reining all of this in at just 2.4%. Let's have a look then. I should add on the food prices. I'll come back to that at the very end, because I think that's not necessarily the last we've heard on food prices. But let's go then to how much of what we've got at the moment in terms of inflation in the US is actually being driven by reopening pressures. Well, this chart from Bloomberg is helpful. The white part is basically the reopening pressures. That's used cars, that's hotels, that's car rentals, that's airfares. So it's making a fairly large contribution, but as one can see, the purple bit at the moment, which is energy, isn't actually making that much of a contribution anymore. A lot of it is base effects, and there are other pressures becoming evident there. 0.3 percentage points is basically the other categories, non-reopening ones. So one can't dismiss this completely. So how's this played out in markets? Well, the fourth chart I have for you today is the US 30-year spread, largely because I'm using the 3 rather than 2, largely because that's the bit where the yields backed up the most, when 30-year yields are the part which came down most. In effect, what it's saying, yes, we may have a little bit more inflation in the short term, but we don't believe it's anything which is going to be durable, and the Fed is going to be on top of it in any case. So we've pushed that spread back down towards the lows that we've seen recently. How about how things look in terms of break-even inflation rates? Well, that's my fifth chart. I think what's interesting here is we've been trading sideways for quite some time, but in the last couple of days, we've spiked up break-even inflation rates. So markets aren't completely dismissing this. How about prospects going forward? Well, the sixth chart is a chart of agricultural commodity prices. There's still a lot of drought effects to come through here. Transport costs, we know the US having extreme heat are following Brazil and Argentina. So food prices could go up a lot more than people think. And my final chart is basically to make the point, it's the NFIB companies expecting higher prices. As one can see, it's at the base, basically at the highs, which basically is saying companies can pass on cost increases. And that, I think, is perhaps the biggest threat in inflation terms. Jury's still out. That's all for this week.